Yeah, for sure. Natixis Investment Managers, we think about this regularly. And within the ETF business, for sure, we have a combination of both legacy or franchise products that are well known by the market already. And then we're also thinking about the next generation of products, so the innovative products that we've more recently launched. And certainly, this is no different than any industry where a product developer and those in the C-suite have to be thinking about the existing and the new. So I don't want it to be it sound like something that's unique to just asset management. And maybe the best way to describe how we think about that is looking at our existing business mix and how we think that through. So within the Natixis ETF business, we have four ETFs within our family of ETFs, about 600 million in assets. We have two products that have been in market for some time, that have very strong performance, that have a long following of investors, and the investment teams have been running those strategies for a long period of time. So one is with Loomis Sales, one is with the Harris Oakmark Group. LSGR is one of the tickers, and the other ticker is OAKM. One large value, one large growth. And again, we support those products strongly, always looking to ensure that the messaging, the performance, and the pricing is within what we would expect of ourselves and want for our investors. But separately, so again, that being legacy, separately, we think about innovation. And more recently, about a year and a half ago, we launched GQI, which is a gateway ETF, one of our affiliates, that's into a new category. So a derivative income category where we're able to provide some risk management at the top level of this US equity product, but also through options, be able to generate income for investors. So this is how we think about, again, maintaining the legacy products, the franchise products, also being confident to launch new innovative products that will likely become the legacy and franchise products of tomorrow. Sure. The last decade has been outstanding in returns for equity portfolios. We've seen many years of double-digit returns and very few of declines. But as we launch into the second quarter of 2025, with some of the concerns around market volatility, in particular related to US tariffs, I think more investors will be considering alternative investments. But even beyond or before these concerns around tariffs, we began to see that interest arise. And we could see investors seeking out alternatives that are really uncorrelated to the US markets, US equity markets, I should specify. And that could be long short, it could be market neutral, it could be global macro and other strategies. So again, I expect more interest in alternative ETFs. Yes, I think the main evolution over the next 5 to 10 years for ETFs will be increased usage of alternatives. And we certainly talked about that quite a bit over time. And specifically, we've already seen that begin with some credit strategies in the alt space show up as ETFs. So we've seen this in traditional private credit as well as CLO private credit oriented products. And I think that will only continue. So with that being one piece of the growth chain, another would be looking at options-oriented products. And we've seen an increase in options-oriented products that are driving, again, risk mitigation through the options usage, as well as increasing income for investors through options. So I think those are a few product-specific ideas for innovation over the next 5 to 10 years. But the last one is around more structural innovation in ETFs. And one of the themes there is multi-share class, or otherwise called dual share class, where potentially if the SEC approves this request, what we could see is a single entity having both mutual fund and ETF classes off that same entity. And we're excited about what this could do for investors in that it could, number one, provide choice for investors. They could choose a mutual fund class or an ETF class off the same investment strategy. Number two, with now all assets for that same strategy that are in 40 Act being part of the same entity, it creates scale and potentially could lower costs. And thirdly, we could see improvements in terms of tax efficiency for those that have historically held the mutual fund classes. So these are the three ideas that I think really we could see in the next 5 to 10 years being innovations. Again, general alternatives being used more actively beyond perhaps just credit. Number two, more in options-oriented ETFs. And number three, dual share classes or otherwise called multi-share classes. Right. There are certainly a lot of different topics that one should think about with innovation in the ETF space and different tactics one can use to innovate. But I think it all starts with having a corporate culture of openness and a spirit of entrepreneurism within the company. And I am thankful that my thinking, which is openness and having that entrepreneurial spirit, is something that my company also embraces and promotes. So I think there's nothing more important than having that as a starting point. Thereafter, it's a combination of having one's investment teams, one's product teams, one's client-facing teams, and other support groups within the company come together, test new ideas, set up focus groups with clients and test the ideas there, and then bring that to market. But again, the most important principle in being able to innovate, for sure, in my mind, is a culture of openness at the company.
E